Good morning, traders. This is Forex Market Commentary brought to you by Real ECN. In today's commentary, we will discuss the Aussie US dollar rally observed at the end of last week's trading session and how it continued onto this week, and a fundamental shift in market sentiment on the Aussie. If you're trading or have been holding this position, you were probably wondering how you can strategize your trade from here onward, and hopefully this commentary will help you with this insight. First, in line with this commentary, we will discuss the Aussie US dollar technical front. Here we have the Aussie US dollar hourly time interval chart. The Aussie US dollar had an extraordinary run since the beginning of this week's trading session. The aftermath of last week's FOMC meeting saw the Aussie US dollar market bottom out on an intra-week level of 0.900 zone before the beginning of this bullish run. There were hiccups during the run observed during last Sunday upon the release of a disappointing Chinese HSBC manufacturing PMI. Nevertheless, the selling pressure was quickly exhausted as this bull run continued onward, breaking out from the 0.91 level and eventually the 0.92 level during yesterday's trading session on a disappointing US core durable goods order. Recapping this week, the Aussie bull run price action on the cross indicate that it has tested and break out from the 38.2 Fibonacci expansion at 0.9177 level, with the second leg of resistance to take out at 50% Fibonacci expansion at 0.9233 level. In the case that buying momentum on the pair can help it take out the 50% expansion, the third leg of resistance target is set at 61.8% expansion at 0.9290. One possible explanation to this rally could be due to traders covering the short positions. Since Tuesday, speculative net short positions have dropped by 35%. However, short covering is only responsible for short-term rally, not long-term bull market. In order for this to materialize, strong fundamental factors must come into play, like speculation that the Chinese government may implement more stimulus to cushion the slowing economy. Analysts are suggesting hold positions on the Aussie US dollar cross at this moment, especially entering into a long Aussie trade at this elevated level, is highly not recommended, while there hasn't been a clear solid bearish signal to indicate short trade either. Analysis of a collection of technical indicators on the hourly time interval on the Aussie US dollar market is suggestive of a temporary neutral market sentiment and recommend hold positions on the Aussie. The Aussie began today's trading session at the beginning of Sydney trading hour, inching closer to a short-term Fibonacci support at 0.9215, while the Fibonacci resistance is set at 0.9233. The Aussie bullish momentum is shared on the RSI as it trades in the upper 50 price value, while at the same time the trend is also trading above the 200-day simple moving average. This trend action hold great significance as 200-day simple moving average contain more or less of 1 year's worth of trading data, and it forecasts long-term market sentiment, and currently the pairs are trading above the 200-day simple moving average, which is indicative of long-term bullish market sentiment on the cross moving forward. However, the short-term moving averages front, the Aussie opened today's Sydney trading session below the 5 and 10 simple moving average, but above the 20 and 30-day simple moving average. Therefore, collectively, this current trend holds a neutral undertone on the technical front. So moving on to the fundamental front on the Aussie dollar pair, the market sentiment towards the Aussie going into 2014 has been relatively negative, and this was largely due to weak Australian fundamentals. As of last week, the Aussie appeared to defy gravity after the FOMC announcement and rally significantly, while the other risk-associated currencies such as the euro is struggling to find solid footing following a major sell-off. The weak Australian fundamental can be attributed to two factors: China and relative monetary policy differential between the RBA and the Fed. It is common knowledge that China is Australia's largest consumer of raw material. As of lately, the Chinese economy is aware that the economy can no longer be sustained on cheap manufacturing, and as the Communist Party attempts to turn the world's second largest economy from low-cost manufacturing-based economy to a consumption-based like that model after the OECD countries, the concern was that Australia would be hit hard. At the same time, the Federal Reserve is beginning its first cycle of monetary policy tightening by trimming down its QE program by $10 billion a month. at every FOMC meeting. Overall, the consensus was that these factors will hinder growth domestically. However, quite the opposite occurred. The Australian City Economic Index rose from minus 19.0 in January to 49.7 by March. This is a clear indication that the economy has been improving at a rate more than the economists are expecting. The labor market also ticked higher for February when the economy added 47,000 jobs. Overall, gradually there's a shift in Aussie fundamental, and looking forward, this could be the very factor that supports future bull rally in the Aussie. From the RBA standpoint, Glenn Stevens will do all that he can to try to talk down any Aussie rally, as he reiterated to the market numerous times that for the benefit of the economy, the bank favored the exchange rate to be at a level of 0.85 against the greenback. However, the market would only react bearishly towards the Aussie if the bank backed their words up with monetary policy plan of action, while in the meanwhile, the bank is pursuing the stepping back approach. So over in the United States, the market begins to see some improvement in leading economic prints. The first upbeat economic prints for this week came out strong, and that was the CB consumer confidence ticking at 82.3 when forecast sits at 78.6. Also, durable goods order month-on-month also beat expectation by ticking up at 2.2% when forecast was at 1%. Meanwhile, core durable good order fell to 0.2% below expectation of a 0.3% reading. Today, the market is anticipating the release of GDP quarter-on-quarter number forecast to grow at 2.7%, while pending home sale month-on-month is expected to grow at 0.3%. Finishing off this week, the market is also awaiting the Michigan consumer sentiment to read at 80.5%. I want to thank all our listeners for spending their time with us, and until then, have a happy trading, everybody.